Costco operates 890 warehouses across the globe. The company generates $254 billion in annual revenue. Members pay $65 to $130 just for the privilege of shopping there. Yet Costco's profit margin hovers around 2%, far below Walmart's 3% or Target's 4%. Most retailers would call this a failure. Costco calls it strategy. This is the story of how limiting profit became the foundation of a retail empire. In 1976, Saul Price opened the first Price Club in a converted airplane hangar in San Diego. Price had already revolutionized discount retail with FedMart, but his new concept went further. He removed all frills, stacked products on industrial shelving, and charged customers $25 annually for membership. The model worked because it flipped traditional retail economics. Instead of making money on markups, Price Club made money on memberships. This allowed Price to sell products at near wholesale prices while still turning a profit. Within 3 years, Price Club expanded to 7 locations and generated $135 million in revenue. The membership fee created a psychological contract. Customers who paid to shop felt compelled to make that fee worthwhile by buying in bulk. Jim Sinegal worked for Saul Price at FedMart and Price Club for years, absorbing every lesson about warehouse retail. In 1983, Sinegal and attorney Jeff Brotman opened the first Costco in Seattle, with backing from $7 million in venture capital. Sinegal copied Price's warehouse model, but added his own philosophy: treat employees well, keep prices low, and never raise markups above 14% on any item. Traditional retailers marked up products by 25% to 50%. Sinegal's 14% cap meant Costco would make less per item, but sell far more volume. By 1985, Costco operated 17 warehouses across 5 states. Price initially viewed Costco as competition. The two companies battled for market share throughout the 1980s, each opening warehouses in the same cities, sometimes within miles of each other. Chapter 3. The merger that created a giant. In 1993, Price Club and Costco merged to form Price Costco. The combined company operated 206 warehouses with $16 billion in annual sales. The merger made sense on paper, but internal tensions emerged immediately. Price's son-in-law, Robert Price, became CEO, while Sinegal served as president. The two men clashed over strategy. Robert Price wanted to expand internationally and increase markups. Sinegal insisted on maintaining the 14% cap and focusing on operational efficiency. By 1994, Robert Price resigned. The company rebranded as Costco Wholesale Corporation, and Sinegal took full control. Under Sinegal's leadership, the company doubled down on its founding principles: pay workers well, keep prices low, and let membership fees cover overhead. Chapter 4. The hot dog that never changes. In 1985, Costco introduced its food court combo: a quarter-pound hot dog and a 20-ounce soda for $1.50. Nearly 4 decades later, that price remains unchanged. When Sinegal retired in 2012, incoming CEO Craig Jelinek proposed raising the combo to $1.75. Sinegal reportedly told him, "If you raise the price of the hot dog, I will kill you." The hot dog represents Costco's entire philosophy compressed into processed meat. The company loses money on every combo sold, but the loss serves as a visible commitment to low prices. Members who see $1.50 hot dogs trust that Costco keeps all prices as low as possible. The food court generates $1 billion annually, despite rock-bottom prices. It drives warehouse traffic and builds customer loyalty through consistency. Chapter 5. The Kirkland Signature Takeover. In 1995, Costco launched Kirkland Signature as its private label brand. The name came from Kirkland, Washington, where Costco's headquarters was located at the time. Today, Kirkland Signature generates over $60 billion in annual revenue, making it one of the largest consumer packaged goods brands in the world. Costco uses Kirkland to replace expensive national brands with cheaper alternatives that meet or exceed quality standards. The company finds manufacturers with excess capacity, often the same factories that produce name brands, and contracts them to make Kirkland products. Members get near-identical products at 20% lower prices. Costco keeps its 14% markup intact. The strategy works because Costco controls every aspect: packaging, quality standards, and pricing. Kirkland Signature now accounts for roughly 25% of Costco's total sales. Chapter 6. The Wage Strategy Competitors Won't Copy. Costco pays its hourly workers an average of $29 per hour, nearly double Walmart's average of $17. The company provides health insurance to 90% of employees, compared to about 50% at Walmart. This compensation strategy seems counterintuitive in an industry built on keeping labor costs low. Senegal defended it with simple math. Higher wages reduce turnover, which reduces training costs and improves customer service. Costco's annual employee turnover rate sits around 6% for workers employed more than 1 year, compared to retail industry averages of 60%. Lower turnover means more experienced employees who work faster and make fewer mistakes. The wage premium costs Costco roughly $5 billion annually, compared to paying market rates. The company believes it saves more than that through increased productivity and reduced hiring costs. Wall Street analysts have criticized this approach for decades, arguing Costco leaves money on the table. Chapter 7. The Treasure Hunt. Psychology. Costco deliberately creates scarcity and unpredictability. The company stocks roughly 3,700 products at any time, compared to 120,000 at a typical Walmart supercenter. This limited selection forces faster decisions and reduces decision paralysis. Costco also rotates inventory constantly. A pallet of designer jeans might appear one week and vanish the next. This creates treasure hunt psychology. Members never know what they'll find, so they visit frequently and buy immediately when they spot deals. The strategy also gives Costco leverage with suppliers. When a manufacturer wants Costco shelf space, they must offer rock-bottom prices because they're competing for limited slots. Costco can walk away from any negotiation knowing it has thousands of other products to choose from. This model only works because of membership fees. Costco doesn't need to stock products with high margins. It needs products that justify the annual fee. Chapter 8. The Membership Moat. Costco's 135 million members paid roughly $4.8 billion in membership fees in 2024. This revenue accounts for about 70% of Costco's operating income, despite representing less than 2% of total revenue. The membership model creates multiple competitive advantages. It generates predictable, high-margin cash flow that allows Costco to operate on razor-thin product margins. It creates switching costs. Once someone pays $65 annually, they're incentivized to shop at Costco enough to justify the expense. It filters customers. Membership fees attract serious shoppers who buy in bulk, not casual browsers. The renewal rate sits at 93% globally and 96% in the United States and Canada. This retention rivals Netflix subscriptions. Members who renew year after year represent predictable future cash flow that compounds over decades. Chapter 9. The Real Estate Empire Hidden in Plain Sight. Costco owns roughly 70% of its warehouse locations outright. The company's real estate portfolio is worth an estimated $50 billion. This ownership structure provides multiple advantages beyond avoiding rent. Owned properties give Costco flexibility to expand or remodel without landlord approval. They appreciate over time, creating hidden value not reflected in operating income. They reduce long-term costs as mortgages get paid off. Most importantly, real estate ownership aligns with Costco's long-term philosophy. The company isn't optimizing for next quarter's earnings. It's building an empire designed to last generations. When Costco opens a new warehouse, it typically takes 3 to 4 years to become fully profitable. Wall Street hates this slow ramp, but Costco doesn't care. The membership model provides enough cash flow to fund patient expansion. Costco now operates in 14 countries with 135 million cardholders. The company's market capitalization exceeds $400 billion, making it more valuable than Target and Best Buy combined. Yet the formula remains unchanged since 1983. Cap markups at 14%, pay workers well, own the real estate, and let membership fees fund everything else. This strategy violates every conventional retail wisdom about maximizing margins and minimizing labor costs. Competitors understand how Costco works, but can't replicate it. Switching to a membership model would alienate existing customers. Cutting prices would destroy profitability without the membership revenue to offset it. Raising wages would anger shareholders demanding higher returns. Costco built a moat by doing the opposite of what business schools teach. The question isn't whether this model works, The question is, why so few companies have the patience to try it?